Ladies and gentlemen of the crypto space, we're live on a Monday, June 12th at 12 p.m. Midday today. Let's talk about what is going on. Obviously, the markets are taking a fat dump on everyone amidst the response of regulatory authorities from a domestic U.S. perspective on a space that is not a U.S. market. It's a global market. Clearly, the U.S. is one of the largest actors in that market and the predominant actor from a dollar perspective in global markets with regard to all markets. So clearly, the proportional effect is there. And the regulators have imparted significant appreciative pressure. I wanted to talk today and bring everyone back to fundamentals. I wanted to reset everyone's mentality and the way we view capital management and maybe try and bring us back to where we started, how we started thinking about capital. I want to tell that story and hope that will give you perspective on how the path may play out for yourself, your portfolio, and your capital. So everything starts with work. You have a job, you're 18 years old, you're making a couple $100 a week or whatever it is, and you have a bank account with cash in it. We've ascertained over the last many years that there's a risk profile associated with a cash account. Aside from just consumer price inflation, we have the risk profile associated with banking, which we've seen over the last couple of months. That was always there. And we've over the last decade plus have grown quite distasteful of the reality of the fractional reserve banking system and the risks that are presented to us, whether we see them or not. But now we talk about them very frequently. Cash in a bank account has a risk profile, which forces people to deploy cash. You can't save. There's no saving for a future. There's no saving for retirement. So part of what I like to do as a reductionist is eliminate courses of action, which simplifies the equation. You cannot save cash in a bank account to achieve retirement. You cannot save for the future. It mathematically doesn't work. We must deploy cash. We also must save cash because we need to deploy cash in short periods of time. You need to have money in a cash account so you can do an ACH to pay taxes, to pay credit cards, which means to pay bills, to pay your mortgage. So you need cash, so you can't totally denounce commercial banking. So you need to distinguish, you need to have a capacity to distinguish between cash at different time horizons, cash needs at different time horizons. You need cash in a bank account to service those short-term obligations. Long-term is a different story. Now, obviously, this is a very interesting conversation, not suitable for the majority of Americans that live paycheck to paycheck, that don't have extra cash. But that is a reality. That is true, and we must accept that and proceed with the conversation, no less. At least to provide the story to folks that do have that extra cash, so that folks can do a little bit better and make a little bit better of decisions and be more rational with what they do with extra cash. Cannot help folks that don't have extra cash. It's a whole nother financial services equation. Balancing a budget, so on and so forth. And clearly, the folks that have extra cash need significant assistance as well with what has occurred with the Ben coins and the stupid meme tokens that have a wonderfully powerful capacity to separate one from their money. There's no rationality in those types of allocations. Now, bear in mind, this methodology I speak of, this rationality I speak of, this wisdom I've acquired, does not lead to the most exorbitant outperformance. That requires a degree of gambling, a degree of excess risk, which I cannot stomach. I and it's not sustainable, and it doesn't have a high likelihood of success. And I find great comfort in rationality. I find great comfort in telling a story that is sustainable, makes sense, and it will lead to underperformance. But I have isolated the story for myself in such a way that this underperformance I will achieve will outperform relative to many other courses of action and choices I can make for my extra capital. Talking about that extra capital in the bank account that's beyond the short term debt servicing needs. So, as you're a kid, you like stocks, Fidelity, Charles Schwab, what have you. And you're exposed to the notion of capital gains. You buy something, you hope it goes up in price. And we've assessed over the years that things go up in price because you buy and then more people buy after you, which gives you an opportunity to sell, taking a portion of their money. I have very rigorously solidified in my mind that that is not something I want to do. And it's not going to be, it will be something to be done when there is a great likelihood of success to be had. But that is not the base case. When you're young, that was the base case. That's why I'm starting the story like this. What do you do? Oh, I bought some stocks. No. Now that we know, in hindsight of all the experience that we have, that's not what I want to do. I want to do that under very certain specific circumstances. I want to engage with markets like that when it's a positive sum game, when there's significant capital inflow, when there's significant volume, and you have higher lows and higher highs. And that means it's basically up only mode. And we see that behavior cyclically. So I like that way of engaging with markets when you can engage with markets like that. We've learned to respect the markets. And if that condition doesn't exist, we cannot engage with the markets like that. Now, I know there's many folks that have a greater capacity than myself, especially, to engage with short positions, long positions, and gamble with options. And that's cool. To each their own. But fortunately, this is my story. This is my channel. And that's not a practice in which I wish to engage, especially under these current market conditions. So we've just eliminated the vast majority of activity that requires frequent attention. Everything else that can be done with markets can occur at a much slower pace, which means we have time, which means we must exercise patience, which means we're calculated and rigorous and rational as best as possible. So the extra capital, if we've just eliminated capital gains as the game we want to play the vast majority of the time, we could play it cyclically in opportune times. We must focus on the other traditional methodology for capital allocation, which is value, particularly dividends. Dividends and stocks, an opportunity. At this point, we'll jump past some years of the story. I've eliminated the vast majority of corporate equities as investable for myself. I don't trust humans. I don't trust boards. I don't trust a business to properly manage human resources. With regard to CapEx, I don't trust balance sheets and debt and capital raises placed upon shareholders as a burden. It's their choice. It's their decision. It's not a shareholder's decision, especially a marginal, a negligible shareholder, if you even have voting rights. You have no control and no power. Equities are more of a gamble than many crypto assets because the enterprise itself imparts extremely strong forces on the actors to make different decisions. At least with crypto markets, to when you have like an immutable meme coin bullshit piece of crap, it's just organic price action aside from the marketing of highly vested individuals. But it's not like there's an enterprise. In bad scenarios, there is, such with the Ben coins. So they had a very centralized role to play in the stories that were spun about it. But anyway, the point being, I've come to the point where I invalidate almost all equities as investable. Now, bear in mind, I retain exposure to certain equities, but it's an extremely long time horizon, and unfortunately, very distastefully, they are capital gains because these companies offer no dividends. I still appreciate ultra long-term time horizon narratives, and I've had them for many years, and I see no reason that they're invalidated. And if a position or if a narrative is not invalidated, it means it's still in play. So I believe the structure that I've had for my equities portfolio since 2015, 2016 is very much still in play. If anything, over the last couple of years, it's been reinforced, solidified. Confluence has occurred. And I'm more confident than ever with a 2030 time horizon for those particular positions. The same could be said for the prime assets of crypto markets with a long enough time horizon, and that has played out with Bitcoin very nicely. The problem is it's not the most opportunistic. I think there's better opportunity in the crypto markets, especially now. Many years have passed and Bitcoin has run multiples, and we're seeing diminishing returns. 100x on Bitcoin and the world changes in catastrophic ways. Probably the same for Ethereum as well. So that's not necessarily a narrative that I want to occur. And I don't want to align with necessarily that narrative. I don't think it will occur for a variety of reasons. So I don't allocate accordingly. So I'm not, once again, fond of capital gains, even though the long-term time horizon makes sense. A 2030 target on Bitcoin and Ethereum is probably a good allocation. I'm still not fond of it. So where has my mind brought me to? My mind still is on cash flow and dividends of traditional equities, except it's a broken system from a traditional equities perspective. I can't justify allocations to a couple of percent here or there, considering the risk associated with the board wanting to dump a capital raise and sell shares, increase, share issuance so that they could pay for things using shares instead of cash flow or treasury, what have you. But in crypto markets, I think that is a reimagination and a rebirth of that type of concept, and it disintermediates the corporate cash flow. It eliminates the board of executives, at least from a CapEx standpoint, especially from a CapEx standpoint. It eliminates real estate. It eliminates supplies and materials, manufacturing costs. It eliminates all the CapEx requirements of a traditional enterprise. So that equation makes much more sense. And I appreciate that maybe more now than ever. Now, I say this with the market doing what it's doing. And this brings me to maybe the point in the story where I talk about entries and what is the significance of a portfolio when it's a value portfolio or a cash flow portfolio. It's not a capital gains portfolio. And how do you measure the relative success of a portfolio? From the top is maybe missed opportunity from a capital gains perspective, or maybe the capital gains perspective or opportunity wasn't even there. If they were positions that were cash flow positions and then they were never expected to significantly appreciate offering that potential capital gains opportunity, They were just acquired for the purpose of cash flow, much like I talk about cash flow cost averaging nowadays. So you might have had an extremely high valuation for the portfolio, but was that real? Was that significant? Was it liquidatable? Was it realizable? It probably wasn't. So you probably didn't do as bad as you think. I would strongly express now is probably the most important time to solidify how you measure the success of your portfolio and where you measure from. And I assert again, you measure from the bottom. And those ultra highs, those blow off tops are not the way to think of markets and not the way to measure the success of your portfolio or what some would say is a measurement of a failure or a lack of capitalizing on an opportunity to liquidate at December 2021 highs. Too longer of a time horizon. Oh, so now time horizon, we bring that up again. I mentioned 2030 as targets. But now, with regard to value and cash flow, I don't think the measurement should be from those long-term time frames. I think the measurement should be from a relatively short-term time frame, even a weekly time frame. Now, there's volatility. We have depreciation of assets extremely in current market conditions. We have reductions in cash flow associated with the decrease in volume, decrease in liquidity, the negative sum game that persists. So we expect cash flow to come down. We're basically in a recession where velocity of money at the U.S. financial system level is doing what everyone sees it's doing. We see the CPI coming down, basically collapsing. We expect GDP to basically fall off a cliff, as the macroeconomists are suggesting and indicating, and we see in technical data directionality. And I state very specifically that directionality does not just stop and reverse spontaneously, it proceeds to capitulation. We know the directionality of these markets. We expect continued depreciation of assets as assets are liquidated to finance capex requirements. Assets are liquidated also to resolve actors' fears and uncertainties. But what's pertinent is none of these things invalidate the narratives in which I'm talking about. If you had liquid assets, you probably should have gotten rid of them already. That is a very reasonable argument, especially if you need the capital. If you have an increasingly sophisticated portfolio that has structure to it, you could argue you have allocation to assets, volatile assets that are depreciating, and you don't need to sell them. Maybe you don't care about the extra capital. And that's partially the case for an Ethereum position that I feel very comfortable retaining, considering the depreciation. I don't need the capital. I have capital. It loses half its value. Folks would be critical. Folks may be critical of having assets that are depreciating. You expect them to depreciate. I'm preparing mentally to lose what, half my value? What if Ethereum gets cut in half and we have an incredibly bear market? But I would argue it's extra money and I want to own those assets for what it's worth. Now, I also state that this game is scored in dollars. So is that a contradiction? That I have assets that I expect to depreciate. I don't want to sell them because I want the assets. I don't need the capitals, so I don't need to sell them, but they are going to lose their dollar value. So does it make retaining the position irrational, considering the statement this game is scored in dollars? I don't have a specific answer to that. We are humans, which means we act based on both emotion and our cognitive capacity. And we get attached to things. attached to things that have meaning, that offer sentiment. And I like my position at this point. I appreciate it. I'm contributing to retaining a portion of circulating supply. So that's how I justify this choice. And I could liquidate as need be if I need the capital, but I don't need the capital because I have cash flow, because I work, I have a full-time job, very much a capacity to be employed under pretty much all circumstances. So that covers everything. So all this is a discussion about what to do with extra capital and trying to make the best decisions possible. And the best decisions possible aren't necessarily for the greatest returns. If the greatest returns were the best decision possible, we don't need these narratives. What do we need these narratives for? We need these narratives because humans operate in terms of stories, being able to tell a story to explain behavior, to rationalize why we do what we do. And as we tell these stories and they become more robust, they give us a capacity to find comfort. Comfort with our choices and our actions. Comfort with what has transpired, the result of our actions, the profits and losses and potentialities, the unrealized gains that could have been had that turned into realized losses. They'll drive you nuts. They'll eat away at you, these stories, such stories as that. Is there comfort there? The most important thing to find is an ability to have comfort with what's going on in the market. And to have comfort with what's going on in markets, no matter what market it is, requires a capacity to tell the story of what's going on and why it's going on and how have you done and the choices you've made. So, once again, you find yourselves listening to the captain's story about how I rationalize my behaviors, my actions, my interpretations of these markets. I like these stories. They bring me great comfort. And obviously, literally, it's just me talking to myself for like an hour, 3 times a week. But you guys give me great feedback with the commentary, and I appreciate that. And honestly, they help me refine my story. Can you guys honestly? We obviously see that this story has significantly evolved over the last couple of years. It is probably hard to quantify the degree in which this story has evolved over the last couple of years. What a remarkable couple of years it's been. So entry and taking a position is something that we could talk about. Composition of a portfolio. Are you comfortable? Are you comfortable with the composition of your portfolio? I remain completely comfortable with the composition of my portfolio. I made no mistakes. I have plenty of extra capital, and in this market, I'm taking positions, cash flow cost averaging as appropriate. But look what's going on, especially with what's going on, and generally for all of 2022, the vast majority of my stories were you want to buy shit as cheap as possible that pays you money, pays you good money, that has the likelihood of increased volume, increased cash flow for the respective enterprise in the future. The concept of cash flow cost averaging as I presented. So this now more than ever is a period of restraint, of trying to find cash flow assets as cheap as possible. Now, of what I see, nothing of the primary assets we've discussed over the years has been invalidated from a potentiality perspective. I don't want to get too much into that, the potentialities of these assets, but obviously the capacity to print dollar liabilities is the biggest thing in the entire crypto space, which is stable coins. That is something I've said for a long time, and I just will reassert that as something not only I believe, it's probably empirically the case. cash flow cost averaging, wait for the cheapest prices possible. Nothing about these market conditions invalidates anything. U.S. regulators over U.S. assets, they're not U.S. assets. They want to regulate the bullshit, so in many regards I do appreciate what even Gensler is trying to do. But I don't think it works like that. Note that the actions they've taken is is a very centralized DAO, an Oki DAO. What the fuck is that? What the hell is an Oki DAO? One, Coinbase and Binance. Seriously, if you're on my stream, who the hell uses that? So that's my perspective. I'm like, I understand the novice market actor going to some sort of website to engage with a centralized business to do these types of activities, but we are way past that, ladies and gentlemen. We have no need for Coinbase, no need for Binance, probably no need for even like a Kraken or a Gemini for off-ramping. There's a variety of alternatives and options available. Unless that changes, in which case you still have the centralized provider that probably will be around to facilitate dollar liability conversion. But who the hell uses the central? Are you trading? Is it capital gains? That's not the story we've been talking about, at least that I just described for the last 30 minutes probably at this point. So what do you need the centralized exchange for? They do nothing. They offer us nothing from a functionality perspective that we want or need. What we want is to own cash flow assets with the strongest narrative in the entire crypto space. Stable coins, the capacity to print dollar liabilities. Where's a nice chart? I got one of these over here. Yeah, this one's pretty good. With a ceiling of 260 million. What a fair amount of growth. That's a lot of growth in a short period of time. I'm very excited for what happens with this, especially the critical immutability. There's no turning it off. I don't think any of the recent headlines or stories regarding what has been innovated here is significant for the destination of the protocol, the immutable software that's deterministic and it operates unto itself with no capex requirements, no human resources, no nothing. So this probably brings me the most comfort. Now watch it get invalidated as a viable narrative. Listen, as long as I hung my hat on rationality, which indicates this is one of the greatest opportunities I could possibly describe in traditional financial markets as well as crypto markets, then I could rest comfortably knowing that I made reasonable choices. And that allows me to peer through the bullshit of the price action, the bullshit of the regulatory uncertainty over U.S. markets. This is not a U.S. market, what we're looking at on the screen. This has nothing to do with any United States corporate entity. This has nothing to do with U.S. regulators whatsoever at all. And to me, that's an incredible narrative for investment narrative. Anywho, Kazan's in the house. Ray Meister Jr. I need this man's soothing voice amongst all this turmoil in the markets. Yeah, well, prices are coming down. Let's take a look at prices. So I look forward to seeing what happens with the dollar. This tells the story, but we need another 1 or 2 years to see the directionality. I come back to the statement I made. I look at this thing on the 6-month chart. I'm tired of even monthly charts, but you can look down maybe at the monthly and see the respective resistance on the time-weighted average price here on the monthly, which is very consistent with the extraordinary shooting star on the 6 month. So there's a bit of confluence emerging over the last 3, 4 months, suggesting continuation to the downside. Continuation to the downside is indicative of increased liquidity conditions outside of the United States. And that's significant from a capital flows perspective. There's increased liquidity outside of the United States. There's more velocity. There's more liabilities printing and capital expansion and more economic activity, which means more volume, which means more investments, which means more transaction fees and revenue, which is proportional to activity in almost all regards. So this will take, check back in 2025, and that's the complexity here. And that's also a time frame that's consistent with other macro cycles where we expect the Fed balance sheet to be, considering its debt servicing obligations and the amount of debt that needs to be issued by the Treasury capital raise that's occurring between now and the end of the year, and how all that plays into tax receipts. This is the story we've been telling about probably the next 6 months, the next end of fiscal year 2023 time horizon, and what is likely, more likely than less, to play out. What's interesting, and we haven't looked at in a while. This is such a slow-moving chart. I don't even know why I keep it up too much. And this has been getting a lot of attention lately, Ethereum denominated in Bitcoin and that kind of capital flow. I was thinking to look at yields on bonds, but I don't need to. I'm curious of the overall directionality, up or down. We haven't had risk off in the traditional sense where equities sell off into bonds and we see bonds collapse to zero. That occurred in 2020 to the most significant degree, period, in U.S. bond market history. Does that occur again? We need a significant credit event, but it looks like the government is in the process of increasing its capacity to intervene, not with regard to scale. We've had indication that they're going to want to reduce the scale of interventions. They want them to be more precise, which is what occurred with the banks. The banks made their depositors whole, and then the investors lost their capital. So that's my gut instinct of where this is heading. I don't expect significant depreciation. I don't expect the 30, 40, 50% drawdown in equities markets. I expect intervention from a liquidity perspective to retain solvency of the critical infrastructure that allows this current state of financial system expansion with regard to the amount of liabilities in circulation as compared to the amount of dollars available, which is a bit of an inflation state. I expect this relative inflated state of markets to be protected in large part. Someone was calling me. So that's because of the balance sheet. They must maintain the solvency of the system. They can't let the system contract. They can't let GDP go significantly negative. They don't have the tax receipts. Then the budget doesn't balance. They can't allow what occurred in 2020 to occur again. They can't distribute capital to the general public. They can't let consumer price inflation get out of hand. They've been battling consumer price inflation. But that has nothing to do with asset price inflation. So my expectation is probably a response that's probably inevitable at this point, because there's going to have to be some sort of intervention as things continue to get out of control, unless things miraculously don't require intervention, and that'll be extraordinary. But in any case, you're going to have the liquidity cycle anyway, because this thing is collapsing. 2.75%. This thing's going to be at 2% in 2 months. Where's the tax receipts without the inflation? That's what Luke Gromen talks about. There's the inflation that allowed the tax receipts to remain as high as they were, which allowed the federal government's fiscal policies to get paid in any reasonable way. So they need to protect that. They can't afford deflation of prices, significant deflation of tax receipts. And they'll have to do that from a financial perspective rather than a public perspective. Unfortunately, the net result, as I see it, is going to be a significant increase in disparity, which is extraordinary because that's exactly what we've had time and time again, over and over, to the point where 2020 was the greatest explosion of disparity ever. But it's only going to get worse. We're going to see the reinforcement of the idea that the rich get richer and the poor just don't get anywhere. Because if you're just working, wage growth isn't getting you anywhere. But our asset prices, as the financial system is supported and solvency is protected, are going to go up significantly. Asset price inflation will respond to currency inflation, and the currency will need to expand to alleviate systemic insolvency. And the systemic insolvency of the financial system carries over to the public. So the extent of what they want to do is protect the public. And to do that, asset price inflation is likely the destination. Doesn't really make sense any other way from a quantitative perspective to make these numbers work with regard to the pressures in the system. Right now, the system is directionally pointing towards deflationary implosion. If they do nothing, if no one does anything, the system deflates, the liabilities deflate into paper currency, and there's a collapse of infrastructure because now there's a fraction of the amount of currency available for financial activity. There goes the GDP, there goes the tax receipts, there goes the capacity to service debt obligations. Are we heading towards a jubilee and an abandonment of the status quo? I would bet no. I would bet the politicians and the regulators want to preserve retirement funds, 401ks, senior citizen benefits and entitlements. They don't want to disrupt the status quo. I don't think the senior citizens have a capacity to adjust to a new system. They get a check in the mail, in the paper mail. They get a paper check from Social Security. That's all they know. Any disruption to the status quo is not accepted by that community. It's not only fought, even if it's better, just because it's different. It's seen as an attack on their normalcy. But that's understandable also from other demographic segments, from our age group, a millennial age group. The status quo is protected. I mean, literally, I got contract work going on in the living room. This is a perfect example. This is exactly why asset price inflation is coming. I have work going on in my living room. It's going to make my home better. Doing a variety of things with the walls and custom units and sheetrock and painting and all this stuff. It's going to be better. But I don't have a couch and my TV's disconnected. It has disrupted my status quo. And my wife has a capacity to push forward and be like, no, let's go. I don't want to do it. I don't want to change the status quo. I get done with work. I want my living room. I want my couch. I want my TV. I want my normalcy. And I've protected it. I've expressed a great deal of sentiment that I don't want the work to be done, even though the work is going to make my home better. I don't want it to be done because I don't want a disruption to my normalcy. And look, I'm literally expressing it at 40, but you can imagine at 60, 70, 80 how vigorously that population will fight for nothing to change about their operating procedure. They get a check in the mail, a piece of paper, and if that changes, that's going to piss them off. A check, a paper check. that the younger generations, the banks have had to call checking accounts, spending accounts, because the younger generations have no idea what the fuck a paper check is. Ha! Isn't that remarkable? I think the path or the destination is so obvious. The path is uncertain, but nothing about anything that's going on is validating the destination. The path has all this volatility and it'll drive you fucking nuts, which is why I talked early in the stream about understanding and digesting conditions as offering a capacity to find comfort with all the shit that's going on. Find your comfort zone, and if we get back to a point, I'll get back to taking positions. But that really is one of the simpler equations. You want shit that's going to be paying more in the future, and you want to buy it as cheap as possible. And guess whose mentality that is? One of the oldest and greatest investors, Warren Buffett. He wants to buy in a hostile takeover fashion. He wants to buy deep discounts, distressed assets that pay cash. Wants to buy cash flow as cheap as possible, except we, the smaller actors, cannot do that with traditional equities. And just because we can't do that with traditional equities in any meaningful way doesn't automatically force us into the crypto markets. We go to the crypto markets additionally because of the profound opportunity that exists there, because of the scale and scope and specific enterprise that is occurring. The enterprise of non-banking and the printing of dollar liabilities using collateral. There is no greater opportunity than that in traditional financial investment markets, period. There has been no innovation like this since the 1950s. Converting collateral into dollars. Liabilities, but dollars. Spendable equivalent to dollars. It's the exact foundation of the global economy. You don't use dollars. The vast majority of dollars you use are liabilities. So this is why I was posting yesterday and a bit of ranting about folks don't understand dollars. And you don't have to really talk about the market as in depth as what Jeff Snyder does and the delivery he has. He's great and wonderful and knows a lot more about the things he knows about than I understand. But I understand enough to digest his story and put it into my narrative, process it, and assimilate it, and use it and consume it to my advantage to navigate these markets, to identify opportunity, to identify the greatest opportunity I've ever seen. So I want to own very specific assets as cheap as possible. And that simplifies my equation. I have nothing to do but collect cash flow, focus on accumulating reserves. This sounds like Buffett. What does he do? He collects cash and cash, and he finds a distressed asset that produces cash flow, and he acquires it at distressed valuations. Ding ding's in the house. Tapsy, wizard is never late. That's right. Dan, good afternoon. Making any changes to your aura position? This is why the long-term lock, I think, is the greatest innovation in all of crypto. Because if you can liquidate something, one, you're either going to be tempted to, and two, you have to contemplate whether it's the right course of action or not. I have an immediate capacity to liquidate my aura position upon the lock timing out and take that capital, those dollar liabilities, immediately. I don't know. I will continue to think about it. I have about to the end of the month, I think another 2 weeks. We'll see what the market's doing. Frankly, the returns are diminishing, and I contemplate the significance of it from a structural perspective. And I don't think anything that we've talked about is invalidated in any meaningful way. And I think as the market liquidity returns, positive sum game returns, I think maybe they're even in a better position, even though their cash flow is coming down. The complexity there is as the cash flow comes down, it's becoming less productive. So that inherently invalidates the whole point of the position. So to what threshold does the reduction in cash flow invalidate it as something to consider as an allocation? There's no specific answers to that. As of right now, I'm doing nothing, but because the lock expires, I'm forced to contemplate if liquidation is something that's considerable, and that's unfortunate. That's very unfortunate. Curve's getting hammered down to 64 cents. What exposure, what risk exposure do we have to the quantity of protocol ownership that Michael has? It's a great question. It'd be irrational not to consider it and contemplate it. Technically, the most recent structure is broken, so that's invalidated. Still got one heck of an inverse head and shoulders in play. Adam and Eve pattern structurally. It would need to really come up significantly. So I don't know. I don't want to overallocate, but maybe, as Buffett says, some of the greatest opportunities in life are missed because of a lack of overallocation. So what does that mean? The reduction in options include waiting, buying now, which seems probably unreasonable, over-concentrating, which entails, are we going to diversify or just retain cash and not invest? So that's all the behavioral choices you have. When you get a chance, it might be fun to actually just put a list and write down the behavioral choices that you have. 1, 2, 3, 4, 5. What actions can you take? Buy, sell, wait, do it now, so on and so forth. Concentrate, diversify. There's not many choices. So what you want to do as an investor is simplify that equation. And that helps make better choices. Does the massive loan in AVE that's currently collateralized by roughly 32% of circulating supply concern you and make you readjust your position at all? The beauty of the position is it's not a position. It was a purchase. I own something. I cannot liquidate it. And I've simplified that part of the equation. That's why I often say these long-term locks are one of the greatest innovations. They simplify the equation. And that's meaningful because these are very hard choices. So I don't think it has an impact at all on my decision capacity of what to do going forward. I think, like concentrate further, diversify, or do nothing. That's there, whether that is a reality or not. So what's going on AVE with Michael, that doesn't invalidate the narrative. Is he the benevolent shark with the little fish swimming around of the biology narrative or simile that we've discussed? Because this is all an extension of biological behavior. Risky crypto, Paul, Alex, the score of the game is really all that matters. In life, it isn't the end per se. Yeah, well, the score is scored in dollars. Always remember that. Soon, good morning, buddy. If it was potential returns over comfort and self-empowering narrative, we would be buying things we didn't like at a higher clip in order to take bigger risks, and how I interpret this idea at hand. Interpret away. Complicated topics, and I really hope that everyone takes my stories and makes their own. Shinzo, time to be greedy when others are fearful. I think there's going to be more fear and a better opportunity to be greedy. The directionality of the market persists. The directionality does not spontaneously reverse. I see no reason whatsoever why markets will meaningfully start to appreciate. It's a negative sum game. We go over here and we can inspect that we're at minus 0.87% for the week on all networks. $68.71 billion minus 0.47% on mainnet. So nothing is changing. When you start to see this at 1, 2, 3%, then it's changing. And then that's how you find bottom. You don't find bottom by looking at specific assets. You find bottom by watching capital flows. When capital starts flowing into the market, capital carries momentum. You start to see this at 1, 2, 3%. You start to see maybe M2 tick up. No, I don't want to do that. I want to do this. You see M2 tick up because M2's down, negative sum game domestically in the United States. It's not a negative sum game globally, considering the behavior of Japan and China. But you really need the United States to participate in that global liquidity for directionality to change. Hey Noah, what are your thoughts on procuring additional Ren dark nodes? I have zero interest in additional dark nodes. I have legacy positions. I have dark nodes. They just sit. In fact, they're actually operating, and that's probably a waste of capex. I spent like $30 a month on that. I'm probably an idiot for that, for actually running the nodes, but that's another story. Listen, that was one of the first things I bought when I got deeper into markets in early 2020. Late 2019, I think, was it Chaos Net was when I acquired them. So, let's see what happens. That's a little punt. It's a little punt for me, is what it is, all things considered. And I'm not going to change that behavior. That's the behavior I found conviction in, and that's what I'm proceeding with. Hope that helps. Also, are you a fan of the liquidity protocol? Yeah, liquidity is a big deal. Critically immutable, dollar liability printing using, basically risk-free collateral, Ethereum denominated. That's meaningful. From an LQTY as an asset opportunity perspective, unknown. The critical immutability is enticing from a narrative perspective, but from an investment perspective, it doesn't seem productive to the degree in which I would find interesting from an allocation, for an allocation to be considered. So, I'm quite interested in what plays out with dollar liabilities in the next couple of years between CRV-USD, GHO, USD Zero, Tapioca, and even DAI for that matter. Tether and USDC. This big stuff. That is the final frontier of what the hell is going on in the global eurodollar market. And the eurodollar market accounts for the vast majority of currency units on the planet. And that's quite fascinating that this is the innovation zone that most people don't identify because they label it all crypto. And that's not what this is. This is finance. And this is not a U.S. market and all that stuff that social media doesn't highlight that really needs to. This is not a U.S. market. It's affected by U.S. markets, but it's not a U.S. market. If $100 billion flowed onto Ethereum mainnet from any damn country around the planet, it doesn't matter what the hell is going on in the United States. The markets would go parabolic. There's only $68 billion on Ethereum mainnet. If there was $168 billion, the financial activity, the velocity, the currency expansion, the asset valuations would be insane. So, in many regards, I want to see what's going on in dollar liability liquidity outside of the U.S. It's a much bigger world than just the U.S., so those conditions are directly capable of influencing this particular emerging market, Ethereum mainnet in this instance. Because cash, capital, liabilities could flow in from anywhere. They don't flow in from the United States. They don't flow in from the New York Stock Exchange. They don't flow in from a KYC, US, SEC, registered, whatever. Has nothing to do with the liquidity flow into DeFi markets broadly, but most specifically Ethereum mainnet, which is the biggest. It's the market. It's the primary market. It is an emerging market. I know that you focus on Forex, but with the current problems of centralized exchanges, do you think the GMX would be a good value project? Well, I'm not too fond of the synthetics and derivatives. I'm not too fond of the perps and the trading, and I know a lot of folks are interested in the gambling aspect of the crypto space, and it's just not my interest, and I use that to invalidate it as a consideration. I'm not even too interested in Forex, really. I like the idea, but what happens is dollar liabilities is so much grander in scale and scope and so much more transaction fees as compared to FX markets. There's fees associated with creating dollar liabilities. It's a loan, it's a debt position, it's a collateralized debt position, and those fees dwarf FX fees. So that's my primary focus. Hope that helps. One-to-one appointments. I am not Daniel. Maybe I'll get back to that as liquidity improves, as the markets improve, but I'm not. But I picked up Wednesday streams again, so please feel welcome to chime in here. I get to every question. I don't end the stream until I hit everyone's questions. Raul's in the house. Nava. Capitalization rates, cap rates in commercial real estate are going up, which decreases asset prices. How does this fit in with your theory that asset prices are inflating? Real estate is a separate consideration. Asset prices, when I say that, I'm specifically referring to the highly liquid financial asset prices, particularly what's commonly called securities or instruments on centralized exchanges, instruments available by electronic broker dealers, Fidelity, Charles Schwab, stocks, commonly called stocks, crypto, highly liquid asset prices. Real estate does not fall into that category as I discuss it. Real estate is an entire other conversation. Commercial real estate looks incredibly fucked, but that's another complicated topic. For instance, the high mortgage rates are encouraging people to not sell homes, which is drying up supply. So if demand is collapsing because no one wants a 7% mortgage and no one's selling because they can't swap to another home because of the 7% mortgage, that's basically stalling commercial real estate. So what that leads to basically is a collapse of the mortgage brokerage industry, real estate agents. There goes all those transaction fees. See, it's all about transaction fees. So that's deflationary. That's higher unemployment. That just forces policymakers to force the bottoming of the liquidity cycle to decrease rates, with increases credit, which allows capital expansion, increased velocity, and more productivity. So we'll see what happens with commercial real estate, but that's not heading in the right direction. One curious view of pleasure. Zed, good day, sir. May I ask what industry job you do? Super impressed by your thought processes. I'm a software engineer. I've done Android development for the last, what year is it? 14 years, 13, 14 years, give or take, right about now. Been an interesting ride. Good old Google Android. Are you concerned about the on-ramp clampdown going on? Seems to be less and less options available. Bottom line is you engage as best as possible. If you literally cannot move capital around, that changes the choices and options you have. Can it invalidate allocation to crypto markets? Possibly. But there's certain extremes that you may have to consider. Listen, if you got $50,000 a month of income in crypto markets and the US, there is zero way to access that income, that is serious complexity for a livelihood. Do you reallocate? Do you move? So there's major considerations depending on what transpires. If it's an investment and you 1,000, 2,000 a month, 500 a month, $200 a month, and you have different considerations. But just remember to break down these options and choices and considerations in writing if need be, to help you at least visualize what choices and options you have and invalidate choices and options. As you invalidate choices and options and you have less choices and options to consider, it makes the decision-making process easier. Menace North being the owner of the casino. Well, now you're talking. That's a big deal. I would very much love to own casinos. Uh, but I think the biggest casino is the non-banks, as well as, the Eurodollar banks, that infrastructure that prints dollar liabilities. That's the biggest casino on the planet, is the actual financial system. It's literally a casino. Uh, Keep it up, Noah. Miguel. Miguel, yo, man. How much money would you need to make 50K a year in passive income from crypto? You'd be surprised, not as much as you think. You get them probably about, if yields continue to depreciate, probably between 10 to 30%. All of 2022 was about 20 to 40%. 20 to 40%, and 50 grand is, 40% of 100 grand is 40 grand. So 120 grand, and you're making 50 grand a year. So it changes the equation when the interest rates, the yield, is not 5%, 3%, 0.5% of what equities offer you. They're useless equities. What you need is real yield from real business, from enterprise that has not diluted the shareholder yield to the point where it's useless. It's only accessible to countless multimillionaires, 8-figure portfolios, billionaires, 9 and 10-figure portfolios. You can't do that. You can't operate with $1,000, $5,000, $100,000 in equity markets and expect to make a decent income. But you can't do that on 20, 30, 40%. And by the time that 10, 20, 30% gets 10, 20, 30, 40% gets diluted to 5, 10, 15%, what do you think happens to the principal valuation? It goes 100x on the money, 1,000x on the money. So you're 5, 10% on 100x on the money principal value, you're making a significant revenue. So this is a very interesting directionality for the markets. We'll check back in a couple of years. Daniel, what do you think of Umi on Cosmos? Kind of like an Aave for Cosmos. Off my radar entirely. The liquidity on Cosmos is next to nothing. The liquidity on Polkadot chains is next to nothing. I have really no interest in almost anything compared to Ethereum mainnet. Everything is marginal, microscopic, it's just insignificant from a liquidity perspective. No interest. CRV USD yield on CNC. Last topic, I'm going to wrap it up. These derivative protocols are federation participants that operate as sterilizers of excess circulating supply. And they provide additional services atop the base layer. So what you're describing is additional service atop the base layer. When you're talking about with their capacity to attract CRV deposits, so on and so forth, that is a sterilizer. That's much like when you talk about central banks around the world holding U.S. treasuries on their balance sheet. That sterilizes U.S. sovereign bond issuance to absorb excess supply from being in circulation. That's the same thing with CRV. These protocols are attracting, incentivizing, and consuming CRV from circulating supply, sterilizing excess circulating supply, excess liquidity in the market. And that, to me, is an incredible simile for what these protocols do as compared to, what central banks do for U.S. sovereign bonds. The like comparison is extraordinary. All right, let's wrap it up for the time being. I appreciate all of you on a Monday, June 12th, 1:04 p.m. Hang tight. Don't be spending money. This is a period of austerity. Respect the austerita, as Cartman would say. This is a period for making hard decisions slowly, invalidating choices so you make better decisions, and exercising patience, especially rationality. Tell everyone to subscribe. I thank you all. I'll see you again on Wednesday after party on Discord for the most rational community in the entire crypto space. See you next time.